We're going to start a new topic, business organizations. Before we get going, I want to caution you, there's a lot of reading in these next couple classes. You don't need to know anything close to the detail that is contained in the readings. So what we'll do is, you'll be responsible for what's said either on the podcast or in class, but beyond that, definitely don't get bogged down in the kind of detail that the textbook is going into. Just read it for explanation, overview, general understanding. We need to start with a little history. If you go way, way back in time before common law and you looked at the kinds of organizations that people conducted business in, it was pretty uncomplicated. You either had a business by yourself or you had a business with other people. The end. So a business by yourself would be a sole proprietorship. A partnership is when you're in business with one or more other persons. Those were sort of your choices. A partnership is defined as two or more people who agree to co-own a business for profit. It's created by an agreement. You don't need to do anything fancy for it. You're not filing articles of incorporation with the Secretary of State. It's simply an agreement, and as we've seen before, an agreement can be oral, it can be written, although obviously better if it's written down. But it can be implied through conduct. It's simply an agreement. A business for profit means not necessarily that you made a profit, but simply that it was your goal to make a profit. If you've done that, you've already created a partnership. And if you've ever gotten together with someone else to sell t-shirts, for example, for your school organization, ask yourself, did you just maybe unwittingly create a partnership? Joint venture, incidentally, and as you saw from the book, is the same thing as a partnership, except it is limited in its duration or scope. Joint ventures are very common in the business world. For whatever reason, let's say, two companies decide to get together for some particular person. A joint venture for a large construction project would be to purchase steel, let's say, from Korea because it's cheaper. It's like a particular activity, a joint venture between Kellogg's cereal and Minute Maid orange juice because they want to share advertising fees. So at the end of that advertising campaign, they're no longer associated with each other necessarily. It's the same definition as a partnership, but very limited duration. The characteristics of partnerships, sole proprietorships, and joint ventures are that the owners manage the business. The owners are liable if there's some complaint against the business. This could be a contractually based complaint, or it could be a tort, for example, committed by an employee, as we studied with the respondeat superior. So there's been a history of business organizations for centuries. What happens next as we start to enter the Middle Ages is that people started living in larger groups. Little villages became towns, towns became cities. People started living together in greater numbers. That meant that it was harder to manage. All of a sudden you need someone who could build roads, build sewers, do whatever you need to do with a group of people living together. And towns found out that there was no practical way for them to do all that, because someone has to enter a contract with the guy who's going to build the road. So who is that who's going to enter that contract? All the citizens of the city of Sheffield, let's say? You know what I mean? How does that even work? So in common law, they said, let's just create a fake person, a fictional person. We'll call it a corporation. And we'll just say, Sheffield, this little town in England, you're now a corporation, and you, Sheffield, not a real person, obviously, but we'll treat you as if you were. And therefore, the city or town of Sheffield can now enter contracts, let's say to have roads built. It's as if a person entered the contract, although we understand that it's not, but we'll use this fiction of a corporation. What will happen if someone sues the corporation for breach of contract? Who's liable? Well, the fake person is. The corporation is liable. The shareholders are not personally liable for this. Instead, it will be, in this example, the city. So these fictional people can own and operate these businesses. And in a corporation, what happened after this was businesses looked at this, sat up and said, "Way, we like that. Wouldn't that be great if we could separate the ownership of a business from its management? Because that way people could passively own an interest in the business and not be worried about becoming personally liable for business debts. You and I, for example, could buy shares of stock in Apple and not worry if there's some huge judgment against Apple for which we would be personally liable. The worst case scenario for an owner in a corporation is that you'll lose your investment, but you're not going to be personally liable for whatever it is that the corporation did, because this fictional person, i.e. the corporation, they're the ones who will be liable. And this proves to be a great way to raise capital. Look what happened at the end of the Middle Ages in England and throughout Europe. All of a sudden, capital markets started to be created so that people could use money to invest in business organizations, even when they weren't involved with the management. You got a huge capital influx that led to enormous exploration, development, industry, and eventually technological development, partially because you are getting a huge infusion of money from passive owners. Corporations then were permitted for businesses, and now that's the predominant way that businesses are organized, as corporations. So, the owners are shareholders, the businesses are overseen by the board of directors, who are elected by the shareholders, and incidentally, stockholders and shareholders, that's the same thing. It's synonymous. Corporations are managed by managers who are hired by the board of directors. Upper level managers, we call them, it's a fancy name, officers. So for example, the CEO, the CFO, the vice president, all of those people are simply agents or employees of the corporation. But we call them officers because they have a higher level of obligation. Bottom line, the management of the business and the ownership of the business can be separate. Because you and I are not managing Apple, the liability remains with the person, in other words, the corporation, and not directly with its owners. And the corporations are taxed as separate people. So those are the characteristics of a corporation. Here's the problem. Suppose we have two people. Let's just take Laura and Teresa, and they own a business. In their first year of business, and let's say they're really successful, together they earn $200,000 and they split it equally, 50-50. In all of these hypotheticals we're going to be using for the rest of class, just assume that everyone has a 10% tax rate. This isn't realistic, but we're not trying to learn taxes, we're just trying to see how this works. Now, looking only at Laura and compare the tax consequences. With L&T as a partnership, Laura made $100,000 this year because she got half of the $200,000 the company made. Again, assume the 10% rate. She's paying $10,000 in taxes and she's netting $90,000. Instead, let's assume it's not a partnership, but Laura and Teresa have decided to incorporate. Now, who pays taxes? People. Who's a person? Well, the corporation is. So now L&T Inc. earned $200,000. Again, assume a 10% tax rate. The corporation is taxed $20,000. Now, after you subtract that from $200,000, you have $180,000 available for our two shareholders, Laura and Teresa. Laura's half of that is $90,000. She has income now and has to pay taxes on it. Again, assume a 10% tax rate. She'll be paying $9,000 in taxes and netting out at $81,000. This is what's called double taxation. The corporation is paying tax on its profits, and the shareholders are paying taxes on the distribution. It's the same pile of money that's getting taxed twice. Initially, corporations look like absolutely the right choice in terms of liability, but on greater reflection, maybe not so much. Because now Laura and Teresa may never get sued, so the liability concerns may be exaggerated. What we know for sure is that Laura and Teresa are going to have to pay taxes, and that'll happen every year. If this is the setup, it's costing them money to incorporate. I want to point this out because if you think about our textbook, who wrote it? Lawyers, law professors. And what do lawyers care about? Lawyers care about liability. From their perspective, the most important factor in analyzing what kind of a business you want to organize is liability. You're sort of seeing the story of the blind man and the elephant. If you're only feeling one part of the elephant, let's say the trunk, you're not seeing the whole thing. If all you're seeing is liability, you're not seeing the whole picture. Taxes are a pretty big thing to be missing. Also, there are management differences amongst corporations and partnerships. Partnerships are managed directly by the owners. Corporations, by contrast, are managed by employees who are hired by the board of directors, who are elected by shareholders. So the management and the ownership could be separate. These are important factors to consider before you decide on a business organization. We can see, though, that with L&T, a partnership, and L&T, a corporation, if your only concern was liability, which would you prefer to be? A corporation. Because if a business commits a tort or has a breach of contract claim, it's going to be more straightforward. It's easier. You won't be personally liable. The corporation will be liable. It's a little bit different for torts because remember, you are always going to be liable. We can see, though, that with L&T, a partnership, and L&T, a corporation, if your only concern was liability, which would you prefer to be? A corporation. Because if a business breaches a contract, who will be liable? Is Laura individually liable? No, the corporation's liable. It's a little bit different for torts because remember, you will always be liable for your own torts. So if Laura runs over some poor pedestrian, Laura will still be personally liable if she was negligent. But the bigger problem is the liability for the business. There are investors who are worried about being personally liable, and incorporating helps relieve investors from that concern. So, if the businesses make money, would you rather be a partnership or corporation? You'd rather be a partnership because you get a direct flow through of profits and you avoid double taxation. What about if the business lost money? Would you rather be a partnership or a corporation? Let's look. Again, let's say in their first year the company lost $100,000 and that loss will be split evenly between Laura and Teresa. Let's just hope Laura has some other income. Let's say she's married and her husband makes $120,000 a year. She had a $50,000 loss from the L&T partnership. So she and her husband are going to deduct $50,000 from the income they had, which gives them a net of $70,000 of income that year. They'll pay $7,000 in tax, again assuming a 10% tax rate. On the other hand, if L&T Inc. lost $100,000, then L&T Inc. lost the money. There's nothing a private individual can do with that deduction. At least there's nothing Laura or Teresa can do with the deduction because they didn't personally lose any money. The corporation did. So, since she can't deduct the corporate losses from her personal income, her full income tax between her and her husband's income of $120,000 is that they'll pay $12,000 in tax. So, would you rather pay $7,000 or $12,000 in taxes? You can see that even if you lose money, you would rather be a partnership than a corporation because you want to be able to write off the deduction. Whether you make money or lose money, you're better off as a partnership because of the direct flow through of profit and loss. Businesses did not like these two solutions because one is clearly better for liability and the other solution is clearly better for tax consequences. So they came up with a solution of limited partnerships. With limited partnerships, you must have at least one general partner, but you can have an unlimited number of limited partners. General partners are just like partners in a regular partnership. But a limited partner is a passive owner. They invest their money. They will not be personally liable for the partnership debts. And you get a direct flow through of profits and losses. So it's a bit of a hybrid of corporations and partnerships. At this point, I need to tell you what a security is. A security is interest in an enterprise, profits of which will be earned through the efforts of others. Why do you need to know this? Well, all of a sudden it becomes important, and I'll tell you why. First off, look at what a security is. You make money because of someone else's work. That's like the dream of capitalism. Wouldn't you love to make money because of someone else's work? We all would. So when is that happening? Is it happening in a partnership? No, because it's the partner's duty to serve the partnership. Is it happening in a corporation? Yes, because if the corporation makes money, it is because the employees generated wealth for the shareholders, and the shareholders and employees are separate capacities. Of course, a shareholder can also be an employee, but they're not necessarily. They can have separate capacities. And if you make money on your Apple stock, it's not because your work for Apple increased Apple's wealth. Instead, it's because Apple's employees generated wealth for you. Your shares of stock in Apple are securities because you are earning money off of someone else's labor. Why do we care about securities? We care because the sale of securities and the exchange of securities is regulated by the Securities and Exchange Commission, a federal agency. The states also have equivalents of the SEC. The SEC reporting requirements are significant. You have to meet these requirements for registering the securities before you issue or sell them. Basically, no one who is not a specialist in this field does this. There are attorneys who simply put together packages that get filed with the SEC. There are accountants who do nothing but SEC compliance. This is going to be expensive, both time, because there will be a delay in instituting all of this, and money, because of the cost involved. And your little startup business would like to avoid that if you could. There are some exemptions for small offerings. The definition of small offerings changes with time, so if you get this far in your thinking, take a look and see what it is currently. Now we have to look again at securities earning money through the efforts of others and look at partnerships. Are they selling securities? A general partner is someone who needs to work for the partnership business, so that's not a security. The limited partners have no requirement to work for the business, but they will make money through the direct flow of profit and loss through the business activities. That is a security. So this is something to take into account. You could theoretically have an unlimited number of limited partners in a limited partnership. However, what you tend to find is that most companies don't go over what the current SEC limit is. Last time I checked, it was 75. So what you find is that limited partnerships tend not to have more than whatever the current limit is for SEC filing. This would not be suitable for Apple Corporation because they have a lot more than 75 shareholders. Here are advantages and disadvantages of limited partnerships. Advantages include you get a direct flow through of profit and loss. You avoid double taxation. You get limited liability for the limited partners. Disadvantages include unlimited liability for the general partner, so someone has got to be that general partner. The sales of limited partnership shares are securities, so you need to make sure you fall within the exemption of reporting requirements or be prepared to comply with SEC filing requirements. Limited partners are prohibited from engaging in management because if they are, then they'll be considered general partners and they've just lost their limited liability characteristics. So if you want to own and run your business, limited partnerships aren't that good for you. Where do you see limited partnerships today? You tend to see it in businesses where up front there are huge losses. These are often very risky kinds of businesses, but the upside looks like it could be significant. Down the road, it looks like there could be a lot of money. So think about it. Why would you want to generate a loss? Actually, I wouldn't, because it wouldn't benefit me very much. But if I were really rich, yeah, I would be willing to risk some money on an oil well, let's say, which could give me an immediate deduction. And maybe down the road, when we strike oil, I'll be even richer. And that would be great. So people who can use the initial deduction of losses and would like to have the possibility of a big upside financially, limited partnerships are very attractive for them. If they don't want to participate in managing a business, for example, you often see this with oil and other mineral explorations. You see them used often for real estate development, where there's a lot of upfront cost. Think about someone who's building a new football stadium. Is it going to make or lose money? Initially, it is going to lose a bunch of money because buying that land and building such an expensive structure will cost a lot of money. So the first few years, it'll probably just be losses. And then, of course, they hope down the road that it is going to be fabulously profitable. So limited partnerships may be a way to attract investors who are interested in the direct flow through of profit and loss and are not interested in management. Then something else came along. What happened was little mom and pop businesses like, let's say, your local dry cleaners or the restaurant around the corner, are they worried about liability? Let's just say that one of these businesses is owned by a family. Are they worried about liability? Yes, they should be. Why? Because what if someone comes in and trips and falls? Of course, you can get insurance and you can try to maintain safe premises, but you're still worried. This may be the only asset your family owns and you're worried about the business. So, Subchapter S classification was created by Congress to permit different federal tax treatment for qualifying businesses. There are certain requirements, and don't go by what's been written here because the requirements change with time. But the last time I looked, you couldn't have more than 100 shareholders. You could have only one share of stock, only one class of stock. In other words, you couldn't have preferred shares or other kinds of more complicated financing. And it was only designed for individual shareholders. For example, corporations could not be a shareholder. They're really supposed to be benefiting small businesses. So Subchapter S is an attractive choice for small businesses. The effect of Subchapter S is that for federal tax purposes, the business will be treated as if it were a partnership, therefore allowing direct flow through of profit and loss, although it's not. It truly is a corporation, but the tax authorities will treat it as if it were a partnership. So again, it has some of the better qualities of partnerships and corporations. Here's another solution. Let's go back to Laura and Teresa as a partnership or corporation. Suppose that when Laura and Teresa, the business, earns $200,000 extra this year, after they've paid off everything, they have that much left over. What if they paid each other bonuses of how much? How about $200,000? If they're a corporation, the corporation earned $200,000. Then the corporation paid bonuses to their 2 employees of $200,000. At the end of the year, therefore, the corporation did not make any money because they paid out all their money. You don't have to pay taxes on nothing. The corporation pays no taxes. There's no double tax problem because the corporation did not have a profit. So in a way, that's a workaround of the double taxation issue. Well, if you figured this out, and I figured this out, who else has figured this out? The IRS goes along with this as long as the amounts of money you paid can legitimately be called salary or bonuses. In other words, that Laura and Teresa can legitimately say that the $200,000 was generated as a result of their efforts and therefore they can call it a bonus. However, If Laura and Teresa have 100 employees, can they honestly say that the $200,000 at the end of the year was solely earned by the result of Laura and Teresa's efforts? No, of course not. There are 100 more people who helped generate that money. So, if they tried to call it bonuses only to the two of them, Laura and Teresa, the IRS might be annoyed and they might call this disguised dividends. The IRS may say you're really paying yourself profit that the company earned, not just through your efforts, but through the efforts of 100 other people. And we, the IRS, are not amused. We're going to penalize you, tax you, and anything else the IRS can do. So this solution works only as long as Laura and Teresa made bonuses or other employee benefits to themselves commensurate with their true contribution to the company. Newer solutions to this problem of wanting the best of both worlds, wanting limited liability but direct flow-through of profit and loss, include LLCs and LLPs. This has been just within the last few decades that these were created. An LLC is a limited liability company, and an LLP is a limited liability partnership. Your textbook, for some reason I do not understand, puts these two business organizations in different areas of the book. But they're really the same thing. The only difference is that an LLP is limited to licensed professions. You'll find LLPs with groups of attorneys, accountants, dentists, architects, veterinarians. In other words, licensed professionals can create LLPs. No one else can create LLPs. Other businesses, however, can create LLCs. And they're very similar, almost identical to LLPs. For LLCs and LLPs, the owners are called members. You do get a direct flow-through of profit and loss. There is no vicarious liability. In other words, no personal liability for the business debts. Each member is liable only for their own conduct. For example, if you committed tort while on the business of your LLC, of course you will be personally liable. You would anyway. But you won't be liable for the LLC's employees, other employees' conduct and tortious conduct. As with corporations, the worst thing that can happen to you is that you'll lose your investment. Incidentally, you're not responsible for the discussion of LLLPs that's in the text. They don't exist in California, and we're just not that interested in them. So this is a bit of an overview of the different kinds of business organizations. And